Today, Bitcoin notches another week of gains. And as the buzz around tokenization grows, I spoke to 3 experts in the crypto space who can break down the push to bring crypto and real-world assets together. Welcome to CNBC's Crypto World. I'm Tanaya Macheel. Bitcoin capping an up week here, registering a more than 1% gain and its first 3-week win streak since March. Ether, meanwhile, slightly lower, posting back-to-back weekly losses and its 5th losing week in the past 6. Both are flat on the day, Bitcoin at about $26,600 and Ether at about $1590. Not a ton of movement in cryptocurrency prices this week, but interesting to note the Federal Reserve's influence on Bitcoin price may be back in play here following the central bank's latest policy meeting, where it indicated it could keep interest rates higher for longer than previously anticipated. Rates have broken out to new cycle highs, really weighing on long-duration speculative assets, which includes Bitcoin. Chart analysts are looking at a retest of $25,000, some saying it could slide down to $20K if it breaks that support. By contrast, Bitcoin transactions hitting record highs and transaction fees hitting 2021 levels. So much more activity taking place on chain. This is according to CryptoQuant. People finding more reasons to use Bitcoin. It's just not reflected in the price as investors stay on the sidelines and liquidity remains dry. All right, let's jump into our main story. While Bitcoin remains stuck, VC attention is shifting back to Ethereum, while the drumbeat for tokenizing real-world assets, or RWAs, like the dollar, grows louder. This week, I sat down with 3 investors in the crypto space: Stuti Pandey of Kraken Ventures, Maria Shen of Electric Capital, and Kinjal Shah of Blockchain Capital. The 4 of us spoke about RWAs, the growth of stablecoins, and a whole lot more. Here is that full conversation. All right, so thank you all for being here today. I want to start with RWAs because we had a big announcement earlier this week from Citi Token Services. There's also the RWA Summit in Brooklyn, which you attended earlier this week. It seems like it's really been the hot topic of the year. It's been kind of a weird year. Movement is pretty flat, but there's all this buzz that we're seeing again this year that feels a little bit familiar. So if I can start with you, Stuti, what is different now about the space, the market, the infrastructure, anything compared to 7 years ago, the last time I remember this being such a buzzy topic?
No, so you're right. RWAs make a comeback, I'd say every 18 months at least in crypto. I'd say every time the benefits remain the same. Like you still have 24/7 settlement, you have guaranteed execution, you have lower transaction fees because you're cutting out middlemen. But I do think there's a few key things that are different this time around. I'd say, let's put them in 3 categories. The first is the economics of it. The second is technology. And third is credibility of the space. So in terms of economics, over the past few years, interest rates have been very depressed. And that has favored very high growth, high risk assets. So in decentralized finance, you had synthetic yields between even 80 to 200%. So RWAs didn't really have a chance to thrive. Now that rates are down, it's actually these real world assets that actually have interesting yield. And they can really benefit from tokenization infrastructure, and they can also get mind share this time around. So that's the first thing. The second thing is on infrastructure. So Ethereum has come a very long way in the last couple of years. Namely, this emergence of layer 2s, which allow for lower transaction fees as well as faster time to finality. And this really expands the design space, especially for financial applications, which RWAs can take advantage of. And finally, when it comes to credibility, just all this news about Bitcoin ETFs, also Ethereum ETFs, with very key organizations standing behind them. I think crypto is being able to get a little bit of that brand halo upon ourselves, and this is definitely lending some credibility to also RWAs. So, there's a number of things that are different, but there's in terms of the why now. And now I think it's up to investors and up to startup founders to really take advantage of this.
It's been an interesting year for stablecoins too, which I think are kind of a consumer-facing version of RWAs. And to be very clear, we're talking about tokenizing real-world assets on the blockchain, which are on blockchains, which I should have clarified earlier. Stablecoins tokenizing the dollar, right? And we were actually talking about this earlier this week, but it does seem like in places where there is a more unstable currency, like Turkey or like Argentina, perhaps tokenizing the dollar has expanded access to crypto. Would you say, how does that compare to a place like this? And I know that post FTX, there has been a lot of focus, and the drumbeat for use cases beyond speculative trading has gotten a lot louder. So has that happened? And it's just been an interesting year for stablecoins, with some of the biggest ones, other than Tether, being down in market cap, and other models kind of being experimented with. So how has this year in stablecoins helped expand access to crypto? Let's go with you, Kinjal.
Yeah, so stablecoins, I would say, are the first sort of data point for RWAs that I think have really achieved product market fit. Today, there are about $130 billion issued via stablecoins. And just in the past 12 months alone, we've seen nearly $6 trillion of volume. So this is a network that I think is comparable to the Visas and the PayPals, if not approaching what they do today. And a lot of what we're seeing is demand from other countries, other sort of local jurisdictions where they don't have access to cheap, reliable currency and cheap, reliable payments. And so I think remittances, e-commerce, I think those are all use cases that small businesses are using USDC and other stablecoins for. Stablecoins don't have to be dollar denominated, but a majority of them are dollar denominated today. And I think in this interest rate environment, there's probably going to be a shift where you'll start to actually be able to attain a yield on your stablecoins, and I think that's going to be a really big trend moving forward.
How do you separate, I guess, the stablecoins as a sector? It seems like a pretty significant sector these days in crypto. How do you separate the institutional use cases from the consumer? If you could just help, I guess, organize that sector for us. What does that look like right now?
Yeah, I mean, I think you brought up a great consumer use case, right? Which is in emerging economies when inflation is very high or when there's a lot of remittance volume, stablecoins looks very, very attractive, especially if there is limited access to USD. Then stablecoins becomes the alternative for a lot of people in Latin America, in Nigeria, and other places in Africa, to actually do some of these remittances and to keep a part of their savings in stablecoins as well. And so there's definitely a retail use case. There's also a small business use case where suppliers, when you look at the remittance traffic, a lot of suppliers are paying each other in stablecoins or in crypto as well. This is a very small segment, but it is growing. I think the institutional case is also very interesting, and I actually think part of what's different about RWAs this time around is that perhaps the definition of what an institution is also changing. It used to be in 2018 when RWAs first started trending, we looked at institutions like high net worth individuals, family offices, pension funds, university endowments, and that's still true, but there has been the emergence of what I think of as on-chain institutions. When you look at a DeFi protocol like MakerDAO, which has over $5 billion on its balance sheet, and since it started more heavily putting more of its balance sheet in RWAs, that's grown to over $2 billion of its balance sheet in RWAs, predominantly in US Treasury bills. And so, that's been a really interesting shift that's never happened before when you look at where demand for RWAs is coming from. And MakerDAO works with institutions that borrow DAI, which is the stable coin, and effectively tokenize RWAs, tokenize T-bills that MakerDAO then uses in its ecosystem. And so, we're really starting to see the point where there's the retail use case, everyday consumers, there's who's using it for remittances and savings, there's businesses who are starting to use stable coins for paying suppliers, and then there's a lot of on-chain activity from these DAOs, these treasuries, these on-chain institutions that are trying to access yield through RWAs and using stable coins as part of that process.
I guess I'm wondering what, at this point in time, the point is, not to simplify it, but
Sure.
it seems like it's still a little futuristic, like especially with some of these yields being up to 5% now. What I do get it with tokenizing the dollar, I think, but what is the point of an institution like Franklin Templeton, which I think does this a lot, of tokenizing treasuries? I'll stick with you.
Well, this is another thing that's different now from 2018. So we do have stable coins, but we also have DeFi infrastructure. That is not something that existed before. Since 2018, we now have DEXs like Uniswap. We have lending protocols like Compound and Aave, and of course we have stable coins that are algorithmically pegged, like MakerDAO. And so all of this to say that when you do tokenize a real world asset, all of a sudden, before you just kind of held it and maybe transferred it to someone. Now you can use it as collateral for a loan. Suddenly the utility of holding a tokenized asset has increased because of the infrastructure that's come in since 2018.
Okay, so who's using these right now, I guess? Is this still pretty crypto native? I know there are institutions that are looking at this for sure, but at what point, Stuti, do we see this take off as something that becomes normal to the mainstream?
Yeah, so I mean, in terms of usage, we already talked about the use case where in certain markets where you have unstable currencies, crypto has done something very important to export the US dollar and almost contribute to human welfare in a way by doing so. But the other very important use case is our dollars are not always at work all the time. Sometimes they just need to sit in a bank and just stay stable, right? So that is important to companies, it's important to institutions, it's important to fund managers. And therefore, like in the same breath, I think it's worth talking about stable coins that are not just tokenized dollars, right? So, I mean, when we talk about stable coins, we hope for stability. And over the last couple of years, Americans have had a lot of concerns around inflation and kind of the instability of US dollars. And the Silicon Valley Bank collapse back in March also kind of shed light that, okay, US banking is not always perfect, and putting your money in a bank is also not always perfect. So one thing I'm seeing is a paradigm shift, and there are stable coins emerging that aim to be stable, for sure, crypto native, not algorithmic, and fully backed, right? I mean, one example is Athena. And the idea here is that, ironically, Bitcoin had emerged from the ruins of the global financial crisis in 2008. And then just earlier this year, we thought, there was a moment in March where we thought, oh my gosh, there's going to be so many funds and so many companies in crypto and also in tech that might go out of business because they kept their money that wasn't at work in Silicon Valley Bank and various regional banks and found themselves tied to central banking, right? So this kind of new paradigm of stablecoins is aiming to diversify counterparty risk, bring us a little bit more back to crypto roots. And this is not just for institutions in crypto. This is for anybody, right? Yes, you can hold X amount of your treasury or your wealth that you want to keep stable in dollars, maybe some in treasuries, but perhaps you can hold some in this form of crypto native stable coins that are also somewhat guaranteed to be stable, but they just have very different counterparty risk.
And so, going back to the activity, Kanjal, if it's not institutions and there's still a little bit of a trust issue post FTX and even post Silicon Valley Bank, who is attracted to these projects like Athena? From where you sit as an investor, are these themes sort of in line with what you're looking at as well, and what you're hearing about from others in the investor community?
Yes, definitely. I think I would, at a high level, of course, bucket the two users as retail and then institutional. I think on the retail, we're seeing a lot of geographic diversification of who users of crypto really are. So a lot of the use cases around stable coins or putting treasuries on chain or whatever real world assets are occurring in geographies where they don't have access. This is not necessarily a problem for the US persons that might have access to a brokerage account, but it is certainly in other geographies where there isn't access to US sort of assets or any sort of stable asset. And then on the institutional side, to Maria's point, I do think there is a lot of sort of pending demand in the DeFi sort of economy for putting assets on chain and then being able to use them in protocols, whether that's for putting up collateral for a loan or sort of creating some sort of financial instrument on chain. I think that demand is also starting to build.
What is the declining market caps of BUSD and that Binance has had some issues this year, but BUSD and USDC, what does that say about the crypto market at large, and what, if anything, do you expect to see out of these larger centralized stablecoins in general come year end or the beginning of next year?
Yeah, I think with each sort of stablecoin, you have a different issuer, you have different sort of circumstances that are unique to that issuer, and so I think in some of these instances there are, of course, challenges that perhaps Binance is facing that other stablecoin issuers aren't, and I do think some of that demand is going to shift over onto platforms where they already have a pretty established ecosystem around their stablecoin and services that can be offered. So I think some of the existing players are going to get increasingly solidified and grow in their market share.
Well, we're here, like I said at the beginning of this talk, there's been a lull in the market this year, and we've been told so many times that this is a time for, it's a time for builders to put their heads down and build and develop. So, you author the infamous developer report out of Electric Capital. So I do want to ask you what you're seeing right now in terms of trends. How is that, I guess, just the negativity translating on the developer side, and are these like happy-go-lucky developers that are just putting their heads down and building, or what is the pressure that they're feeling? What can you tell us about what platforms they're building and what kind of projects they're working on?
Yeah, it's an excellent question. So right now we're resting at about 21,000 open source monthly active developers. And it's really important to know that this is an undercounting of the total number of developers in crypto. Open source means that Coinbase is not open source, game developers are not open source, a lot of applications and front ends are not open source, but it does give us a trend line and kind of starting point for understanding the level of development in the space. We're also, just this past month in August, across some of the top EVM, Ethereum virtual machine compatible layer 1s and 2s, we're seeing over 70,000 unique deployers of smart contracts on chain. So there's still a ton of activity. That being said, at peak, we were at 26,000 monthly active developers. I think there has definitely been a decline, but when you look at how much prices have declined, 70, 80% plus, developers are staying. And we also looked at we pivoted the data to look at who's actually leaving. It turns out that the developers who are leaving are developers who have been in crypto for 12 months or less, and they contribute 20% of the code, meaning that developers who have been in crypto for more than 12 months, they contribute more than 80% of the code, and they're not going anywhere. They're staying and they're building. And I think qualitatively, I'm curious what you all are seeing, but qualitatively, that's certainly what I'm seeing on the ground as well, is that a lot of crypto curious developers poke their heads in, participated in hackathons, built side projects, and those developers have tended to leave. There are fewer new developers entering the space, but the developers who have been here, who are working on those meaty projects, who are contributing most of the code, they're as dedicated as ever, and they're here.
Okay. And how does that align with what you're seeing, Stuti?
Yeah, so I'm looking at both kind of trends in terms of engineering and also cryptography, because when we talk about crypto, it's crypto economics, and a lot of what we end up talking about is the currency side, but really half of it is the cryptography side as well. So there have been significant advances in cryptography enabling this ecosystem that's that's expanding the design space. Like, namely, there is a type of cryptography called zero-knowledge cryptography, which has received significant attention. So what I'm seeing in terms of like linking also investor themes to developer themes is that it's not always kind of moving at the same pace. So there are some topics, like for example, the intersection of crypto and AI, where there is a lot of investor attention, but the number of teams that can be developing this is small because there's a very high barrier to entry, given that you have to understand both cryptography and machine learning and understand how to apply it to the blockchain. But the amount of investor intrigue is very high. And I mean, the reason for this is that AI is about to touch every sector, that we interact with, and probably almost every professional role that is out there. So there's definitely a lot of questions now about the risks associated with it, and there's a lot of interesting ideas now emerging about how blockchain, decentralization, and cryptography can help curtail those risks and make this better for the consumers that end up touching it or being touched by it. One example is, there's a company called Macheel, which is essentially trying to make AI models more accountable and honest. And they're actually also behind doing some of the infrastructure for WorldCoin. And another theme is, how can we sort of reduce the power that just a handful of companies have on building foundational models, such as OpenAI, Anthropic, one of the other major tech companies. And there's companies such as Jensen, which are essentially allowing access to latent GPUs to kind of democratize the process of model creation. And they're really relying on blockchain infrastructure to be able to do this. So, I see a lot of this design space being unlocked by changes in infrastructure enabled by cryptography as well.
I do want to go back to developers for a second, Maria.
Yeah,
are there any blockchains in particular? And I know that we've mentioned investor attention kind of reaggregating towards Ethereum, which has had upgrades, and we talked recently about how those upgrades make Ethereum more competitive. Are you seeing not excessive, but are you seeing more significant activity on Ethereum from the developer side versus others?
Yeah, I think one big trend is the dominance of EVM. EVM again being the Ethereum virtual machine, and so anyone who's building something so-called EVM compatible means that anything you build is compatible with Ethereum, but then also with a variety, thousands of other chains. And so that ecosystem accounts for over 40% of active open source developers. And that ecosystem has been, very strong from the beginning. What's really interesting is that now applications are supporting not just Ethereum, but a lot of other kind of EVM compatible chains as well. And so you also see that going the other direction, right? Where, hey, I used to support this one chain, it's EVM compatible. Hey, that means I can also build for Ethereum. And so I'm going to launch this same application on Ethereum as well. And so you see a lot of this fluidity. Again, kind of comparing this to 2018, developers used to come in and say, I'm going to build an Ethereum app, or I'm going to build an Avalanche app. Now developers are coming in saying, I'm going to build something that's EVM compatible, and I'm going to deploy to 5 different chains. And so that's been a real shift in terms of how we're seeing some developer behaviors here.
Okay, so real quick to cap this off, 2 big use cases that you're watching now that investors should pay attention to.
I'm very, very excited for the consumer segment. I think Kinjal is as well. We actually just had a discussion about this. It's kind of incredible now where infrastructure has, kind of where we are with infrastructure. It used to be that you were an application and you needed to spend, or you had a great idea for an application, you needed to spend a year or more building the infrastructure to enable the blockchain component to work. That's a non-starter. Now we're at a point where teams can come in and with a few months put something in front of consumers that uses a crypto backend. And we're starting to see the beginnings of what that means. And I think one of the things that I'm really excited about over the next few months is the type of experimentation that's going to happen in that sphere. The second thing that I'm really excited about is kind of as an offshoot of that, I think there's going to be new economic models for creators to monetize. We saw a little bit of that in the last market cycle, but again, I think because consumer apps are so much easier to build now, the UI is so much smoother, it's so much better, it's so much faster with a lot of the scalability advances that we've made. I think that's going to make a comeback, and it's really going to draw in a lot of users.
Okay, Kinjal, your 2 use cases to watch.
Yeah, I mean, I'm in complete agreement with Marie. I think similarly, consumer is really well poised right now. Infrastructure has made a lot of headways. One area in particular I'm excited about is gaming, and specifically on-chain games that can really leverage the blockchain as the source of truth for anything that occurs within a game, which I think is really exciting. And then another use case, I think social is going to be one to watch. There's a lot of movement happening in traditional social, and within crypto, a lot of experiments are underway, and I think there's an opportunity to see some emergent behavior there, which I'm excited about.
Thank you. Your two use cases that you're watching.
Sure. So for me, it always starts with infrastructure, right? I focus quite a bit there. And the reason for this is, you know, I would find it very difficult to build a skyscraper on a mud block with a hand axe, right? So for me, the advances in infrastructure really contribute to downstream impact on consumers. So I'd say like one kind of big segment is, I think that if we can bring costs down to, you know, cents, if not less than that, like less than a cent, and we can bring transaction speeds up and time to finality up, I believe one thing that is really going to be unlocked is there will be very few excuses left to build a fintech application off of the blockchain. I think we'll be able to kind of imagine all of these fintechs like being able to build, whether it's consumer, whether it's for businesses or enterprises, they should be built on the blockchain, or that should at least be, you know, one of the top two options. So that's one place that I'm definitely looking at.
All right.
Yeah.
Great. Well, thank you so much, everybody.
Thank you.
Thank you.
Okay, that's all for Crypto World this week. We'll be back again on Monday, and we'll see you then.